Yep. It does record, I guess, when you hit that. All right. Hi, everybody. As everybody's getting signed in right now, just a few logistical items. Glad that you're here. First of all, we'll get started right at 11:30. So we'll give everybody some chance to get signed in. We do want to start right on time. And we do want to allow plenty of time at the end for questions. So we like to keep these informal enough, in other words, that we can keep them pretty interactive. And we really want this to be educational, but we also want it to be something that we're not just talking at you. We want to also hear your questions, your feedback, and so forth. So feel free to use the tools inside Zoom to be able to do that. All right, welcome. Looks like a few people are signing in.
Coming in, we got some good information for you today.
Yeah, thanks everybody for joining us. We're going to get started here in just a few minutes. So thanks for taking out some time. Maybe you're just eating your lunch or taking some time out of your day. So thanks for giving up part of that. We hope this is really educational, and we'll be digging in here in just a couple minutes. Feel free to familiarize yourself. I think by now, after COVID's been going a year and a half, we're all familiar enough with Zoom tools and so forth, but make sure that you locate the chat feature, because that's how you can ask questions and give us feedback.
Yes, and for everybody attending live, I just want to take a reminder, we have both the question and answer open and the chat as well. So as you have questions, please put them in there. We will do our best to catch them in the moment if we can. Otherwise, we will have a Q&A session at the end of this as well.
All right, well, we're coming up on 11:30 Mountain Time at least, and so that's when we will end up getting started. But glad for those of you who signed in early, that's great. We'll give people a couple more seconds here and then get started.
Good to see. All right, and once again, yep, we have the chat and the question and answer feature open for questions as they come in. So if anything, if you have questions on anything, please let us know. Use those features. We'll be monitoring that as we go along.
All right, looks like we're about 11:30. We ready to go live, Jeremy?
We are ready to go. Go
All right.
for it, Josh.
All right. Well, welcome everybody. The official welcome for those of you who signed in earlier. We already welcomed you, but glad that you're here. And if you are watching after the fact, which actually most people do, so for those of you who are here live, you do have the ability of not just hearing us live and having that interaction, but also the ability to ask questions. So please do that. Use that to your advantage as we go. Certainly, we'll want to make sure that we stay on time. So we do have this scheduled from 11:30 to 12:30 Mountain Time today, and we want to honor your time because we know it's valuable. So today we're going to cover equity awards, and this is a presentation over the years we've done a number of times because really kind of our area of expertise is in comprehensive financial planning. But if we have kind of a niche anyway, that would definitely be the tech sector. We have a lot of employees that are in the tech sector, a lot of clients that end up working in that area, and many of those companies do offer equity awards. So we are going to cover that today. And certainly we're living in extraordinary times right now. Economically, it's kind of crazy when you look at the last year and a half, look at things economically, the stock market, look at how we live our lives. Certainly that's been a huge, huge area. And one area that we'll be covering today is tax implications as well on the equity awards. We're hearing a lot of debate in Congress right now about the tax code and how that might change. So as you're hearing this, some of these rules might end up changing. And I think that adaptability, that flexibility is really what makes financial planning kind of get its magic, right? Is the fact that we can be flexible and adaptable to the circumstances, because in a lot of cases, it's stuff we can't do a lot about. We can't really control the tax code. We can't control the president. We can't control Congress. So there's a lot of stuff we can't control, but we can, do some anticipation, right? I think anticipation is power. It does give us the ability to at least look ahead and try to anticipate what might end up happening. And of course, using the current rules, knowing what we can do in your own financial planning situation. So again, welcome everybody. Managing your company provided equity awards is the name of our presentation today. We've got myself, Josh Nelson, and Jeremy Busch, both certified financial planners, which is the gold standard when it comes to financial planners. You always want to work with a CFP if possible. And you want to make sure that you do that, not only because it means that we've had to study a lot and pass a really hard test actually, but there's also some ethics requirements. There's also some continuing education requirements. And from an ethical standpoint, when you're a CFP, it means that you're a fiduciary. And that's kind of a lofty word in the financial world, but being a fiduciary means that we actually have to act in your best interest. In other words, when we're giving you advice as a client, when we're working with you, we have to give you advice that's in your best interest first, and making sure that we're disclosing anything that you need to know about finances and about your situation. So with that being said, we're going to get started here. Managing your company provided equity awards is, again, the name of the presentation today. And really, it kind of encompasses a few different areas. What we're going to cover today is the main areas, in other words, of equity awards. So there may be equity awards that you've got or you've heard of, in other words, that we're not covering today, and that's fine. But these are the areas that we cover most as far as working with big companies in the US anyway that offer equity awards. These are the main types. So just keep in mind that we may end up having to do some research for you if you end up finding something that stumps us. We don't know everything. So when you give us those scenarios, we might be able to get back to you after the fact if you've got some really exotic equity awards. So with that being said, first thing is that equity awards can be rewarding. And what I mean by that, it's a little bit tongue in cheek, but they can be really rewarding. And in a lot of situations, we've actually worked with clients that literally their equity awards have taken them from being in a good financial situation to being in a awesome financial situation, one more than they ever would have dreamed. In fact, a lot of people will try to position themselves in Silicon Valley and other areas. A lot of times people try to position themselves in companies that not only do they want to work for that company, but they're looking for a rocket ship. They're really looking for some equity awards that will really transform their wealth. So first of all, kind of talking about why would an employer do this to begin with? Well, number one is that equity awards can be rewarding to the employer in that it's a significant way for companies to incent their employees. Ultimately, it's one nice thing to be able to give money to people, but if you can give money to people and not impact your cash flow, that's a good thing. And so oftentimes companies actually use that as a way of incenting their employees because they can give equity awards, they can give stock, in other words, instead of cash. It still keeps the same amount of cash on the company's balance sheet, and that can be a really good thing to preserve cash flow. It's also well known, lots of studies kind of come down to this. I think you probably know this without us having to show any studies, that when you've got ownership, when you've got some kind of a direct participation in that company, it makes you think a little bit different. Makes you think a little bit different about how you're operating on a day-to-day basis, what you're doing that might be able to help the company. And of course, we see that from a lot of our clients that they talk about those strategies and the things that their companies are working on that we're really excited about for the future. So it is a significant way for companies to incent employees. Number two is it's a wealth creation tool for the employee. Potentially. We say by that is that equity awards are risky. There's risk associated with equities in that when we talk about equities, it could be either real estate or stocks. Usually we're talking about stocks. The stock market inherently does have risk associated with it. So it's a wealth creation tool for the employee as long as the stock performs, right? And there's lots of companies that have gone to nothing. They've gone to zero, meaning that options, stock, things like that could actually end up becoming worthless if they're not sold or exercised before that employee ends up taking that benefit. And then, of course, again, participating in your company's success, being an owner, actually having ownership of that company. When you're a stockholder just means you're a part owner. And ultimately, the stock market is just a bunch of us owning little pieces of companies. And of course, those companies change in value every millisecond these days. So it's a way that you can participate in your company's success. And of course, exposure to the stock market in your company's sector, that's an added benefit. Sometimes the tide goes up and it ends up kind of lifting all the boats, right? And so it can be a benefit if the overall stock market's going up, or maybe even just the sector that your company is in. Even if your company is not the best company in the world, sometimes you're getting a lift just because the overall market's going up. So there are some advantages there to have some stock exposure by owning company stock and be receiving that by options and restricted stock units. So they can also present challenges. One of those, again, is that you do get exposed to the stock market and economic risk. And we saw that last year. And in fact, really, we're still in a recession right now in a lot of ways, in that we're still not up to where we were from a GDP perspective. In other words, the economy is still recovering from where it was before. And so we've seen the stock market recover, but the economy is still kind of chugging along. Hopefully the stock market is forecasting that the economy is going to continue going up in the future. So you do get exposure to the risk as well. In other words, the stock market, economic risk. When you have a pandemic hit, when you have a 9/11, it doesn't matter how many stocks you own, or if you own the best company in the world, it's probably still going to go down. You're probably still going to get some losses, at least temporarily. And of course, these events like 9/11 and the pandemic, the market actually came back relatively quick. So we did see a bounce back, but nonetheless, there still is risk associated with that. Now, there's golden handcuffs. And we hear this all the time from clients. In fact, for clients that work for companies that do end up being kind of rocket ships and they go way up in value, sometimes it's actually hard for people to leave. And that could be because you want to go to another employer, but oftentimes we're hearing from clients that they'd like to retire, but it's just so expensive to retire, in that they would be leaving so much money on the table, in other words. Now, again, on the employer perspective, that's a really good thing for the employer, because they're putting those golden handcuffs on their employees, especially really valuable employees. It makes it a lot harder for them to leave because they'd be leaving so much money on the table. So we do find that with people retiring, in that they're trying to figure out when to retire, not because they don't have enough money set aside, but it's just so costly when they look at losing a bunch of options or stock that haven't vested as of the time that they've left. Fear of selling, fear of missing out. I don't want to pay the taxes. We do hear that a lot. And, I started out my career back in 1999, which, if you remember, that was when the tech bubble was at its peak, really late 99, early 2000. That was when all the dot-coms, everything was just going nuts. And it was a tech bubble. It burst in the year 2000. But really, at the time in 1999, when I talked to a lot of people about, gosh, that's a lot of risk. You just have a lot of one company's stock, your own company's stock. And they said, you know what? I don't want to pay the taxes. It's just too expensive to pay the taxes. Well, come the year 2000 and 2001 and 2002, the stock market went down all 3 years, and the tech sector was the worst. Really looking at that area, people wish they could have gone back and paid those taxes, because in a lot of cases, they ended up being left with something worthless, or something worth just a shadow of what it was before. So there's individual company risk. You do get some concentration, especially, again, if your company ends up being the rocket ship, you could end up with a lot of exposure. A lot of your net worth could be tied into that one thing. And that's not a great thing from a financial planning perspective. We don't want to keep all our eggs in one basket. I think our moms all told us that when we were little, right? Don't put all your eggs in one basket. The stock could go to the moon, or it couldn't. And oftentimes we do see them. So using that example, there are a lot of companies, and we could fill up this screen with hundreds of companies that we could think of that really either went away, they're not even around anymore, or they're just a shadow of what they once were. So certainly looking back to 2002, you might remember the accounting scandals in 2002, Enron and WorldCom, they found out they were cooking the books. And they were once known as a couple of the best companies in the world, but they were using some really creative accounting at the time. And it happened to be quite illegal, what they were doing. And when that was found out, there were a lot of companies that ended up going down because of that. The overall stock market dropped, of course, but Enron and WorldCom, they went broke. And I know there was a big site in Omaha. Actually, one of the advisors I know had a client that had all of his net worth in Enron stock. And when the WorldCom and Enron scandals came out, he had been telling him before, you know what, you should sell some of that stock. You should sell some of that stock. Let's diversify it. Let's spread it out. But no, it's going to keep going up. It's going to keep going up because it always had before. And then, of course, when everything blew up, the stock went to zero. Enron, WorldCom, and again, many others along the way. Then there's other companies that just don't change fast enough. And in this world, especially today, things are moving so quickly, you've got to be majorly adaptable to be able to survive as a company. In fact, over the 10-year period, when you look at a company that was born at any given point, they only have a 4% chance of making it 10 years. Believe it or not, that's an accurate figure that for any business that starts, only 4% of it will end up making it to its 10th year. And that's just companies that are surviving. That's not even talking about companies that are thriving and doing really well and innovating. That's just companies that make it to the 10th year. So really your odds as a business making it are not particularly good if you put it all in one area. In other words, you've got to be very, very adaptable. And sometimes you're just lucky or unlucky. So in the case of Sears, used to be one of the best companies in the world, biggest retailer in the US. Remember the Sears Tower in Chicago? Used to be the tallest building in Chicago. And of course, it's been renamed because Sears really isn't in existence anymore, at least a mere shadow of what it once was. Same thing with Eastman Kodak. At its time, back in the 70s, was the biggest tech company in the world. And ironically, they ended up inventing the technology that put them down. They invented digital technology. They failed to patent it. And then others took that idea, ran with it. And of course, Kodak went down in a big way. Again, they weren't adaptable fast enough. The financial crisis in 2008, 2009, Lehman Brothers, Bear Stearns, Paine Webber. There are lots of financial names that ended up going down back in the financial crisis. So it went to zero, sometimes because of unethical stuff, sometimes because they were just over leveraged, sometimes because they were just victims of circumstance. Toys R Us, they ended up going down this last year in the pandemic. And then Blockbuster Video, that's one of my favorite stories. Blockbuster Video had the opportunity back in the year 2000. They had the opportunity to buy Netflix for $50 million. At the time, Netflix was almost out of cash. They were running out of money, and they approached Blockbuster and said, we're out of cash. We really could use some help. We'll let you buy us for $50 million. They got laughed out of the boardroom. And then we saw what happened after that, is that Blockbuster and Netflix went in different directions. So no one stays on top forever. I know we all kind of intellectually know that, but I think it's important to just remember, no matter what's happening right now, somebody is going to end up being on top in the end. In fact, I think Jeff Bezos last year gave an address to his employees and said, Amazon won't be around forever. We're number one right now, but we won't be around forever. And our job as a company is to grow and to innovate as long as we can, to keep it going as long as we can. So just knowing that that business isn't going to survive forever, that's one of the things that actually ends up driving them. So knowing when to sell, the cycle of market emotions is pretty important. And you may have seen something like this in the past, but it's important to remember that investing is very emotional. And I believe that emotional investing is the biggest problem actually that most people end up having, and why they end up having bad returns over time is because they get emotional about it. And as you can see in the cycle here, where do you think we are today? Yeah, I think we're on that uptick right now. Being near an all-time market high doesn't mean that the market won't go higher, but really when you look at where we were in the pandemic last year, the stock market dropped over 30% from top to bottom at that point. And there was a lot of pessimism. I think people were pretty down and thinking that the market was going to drop and drop and drop. And so it was pretty panicky. You can see these emotions here: anxiety, denial, fear, desperation, panic. Much less look back to the early 2000s. Again, 3 negative years from 2000 to 2002. The stock market went down all 3 of those years. So that was a lot of patience that was required to be a good investor during that time. Right now, we might actually be at excitement, thrill, euphoria. Who knows where we are today? But it's important to remember that really we're going to be most tempted to buy stuff when it's at its peak. In other words, if we're reacting emotionally, we're going to be very, very tempted to buy stuff when it's at its peak. It's very expensive. And we're going to be tempted to sell when it's really low. In other words, because we get depressed, things go way down, and people start to really think that things are going to go down forever. And then on the upside, people kind of think that things are going to go up forever. Well, you can see here that the point of maximum financial risk is at the top. Now, are we at the top right now? Who knows? Nobody knows that. Are we at the bottom during that maximum financial opportunity? Well, we don't know. Back in the pandemic last year, the Dow dropped to about 18,000. And now we're at about 35,000 or so, depending on the day. So really, people were pretty despondent at that time and kind of worried about, gosh, how far is this market going to drop before it bottoms out? You don't know either one of those. For people that were hanging on to cash and thinking it was going to go lower and thinking they'd have a cheaper opportunity to buy stocks, they may have missed out. And the same thing, if people are thinking that what they own right now is just going to keep going up and up and up and never see a downside, there's some risk there. So I firmly believe that about 80% of investor success is psychology, it's emotions. The other 20% is the tactics, really the strategies, the funds, the ETFs, the things that we're investing in. It's not that that stuff doesn't matter. It's very, very important, but just recognizing that sometimes we can be our worst enemy. Jeremy, let's talk about restricted stock units.
Absolutely. So like Josh said, we'll go through some of the more, some of the ones, the types of equity awards that we see the most anyway. Okay. And so in doing that, probably the one that we do see the most, it gets used a lot, are restricted stock units. Now they're restricted because the company gives them to you, but they don't say, hey, here you go. These are options for you, or this is stock for you. It's restricted by time. It's restricted by a number of different things. And so what we have are a couple key dates in any kind of equity award. And there's three in particular. There's a grant date, there's the vesting or exercise date, and then the sale date. All right. And so that's where we'll kind of focus on today. So when we talk about restricted stock units, again, most common, company basically grants them. A lot of the times what we'll see is over a few years, 4 to 5 years, I think is typical for a lot of these things. And so they'll give you, say, 1,000 shares, and every year 250 shares vest. What happens is that, I guess the things to keep an eye on is they become taxable when they become unrestricted or when they vest. And so most companies that I think we think of or know of, they do the withholding for you. So when you have a number of shares that vest, they will actually just withhold a few of those shares to pay the taxes on them and then give you the rest of the shares. Not always the case. So that's always something that you have to keep an eye on, or at least inquire with your company about to see if they're doing that. Nobody really likes big tax surprises at the end of the year to say, oh, well, I thought the company paid that. But sometimes not the case, but always good to keep an eye on. All right. And like we said, there's three main dates that we kind of keep an eye on. So for instance, if you had 1,000 shares granted on a 4-year vesting schedule on January 1 of 2020, just the grant itself does not constitute a taxable event because it is restricted. You don't actually have ownership of them. If they were granted to you and you left the company a month later, all of those shares, all of those RSUs would be forfeit. You just don't get them anymore. It's another kind of restriction that they put on it. So they're designed to kind of reward employees, but also entice them to stay. All right. So let's go down another year. So the first year comes, that first vesting schedule hits. And so you get 250 shares. What happens then? Well, when you get those 250 shares, they are considered ordinary income at that point. And so what it is basically the value of when you get it, if there's any kind of discount involved in there, that portion of it becomes basically taxable at ordinary income to you. Okay. Again, normally what we see is the company will say, okay, you get 250 shares, but we're going to withhold some of these shares and pay the IRS the taxes that you're going to owe on this for you. And so you might have 250 shares that vest, but you only actually receive 235 of them at that point. So what happens to those shares then? Well, you own those shares now. You can turn around and you can sell them immediately. And that is done and said. You sell them at current market price and you walk away with those funds. The taxes have already been paid on them. You're good to go. Otherwise, what we see a lot of people do, and this is kind of where Josh was saying the whole fear of missing out thing, right? Is now all of a sudden you own these shares. Company looks great. Looks like it's on the up and up. I'm going to hang on to these shares. Any further growth that they get or drop becomes a capital gain or a capital loss. And so then it's important to keep an eye on your dates. So the date that they vest or get exercised, that becomes your starting point for ownership. And the important thing to remember is that the difference between long-term capital gains and short-term capital gains, 1 year plus 1 day is the standard. So if you were to get it on January 1, 2021, and it's vested, and you sell it on the 365th day, technically that would still be considered a short-term capital gain. That would be painful because those get taxed at your ordinary income rate. If you're in the 35% bracket, that's a big jump, as opposed to if you wait until the 366th day, that's when long-term capital gains kicks in, and that's a flat rate. Most people are in the 15% flat rate, or if you're in the upper echelon, you might be at 20%. All right, so
yeah, and those are historic. One quick point, Jeremy. Those are historic lows right now. Since you mentioned those, it might seem like a lot, but historically, those are the lowest capital gains rates I think we've ever had, really. So kind of keep in mind that there is an advantage for sure. And sometimes people are kind of asking us these days, hey, with all these bills passing and so forth and the government spending, are we looking at higher taxes in the future? More than likely, we don't know exactly what that's going to look like or who that's going to impact, but certainly capital gains, that's one area that you might be thinking about right now.
Absolutely. Yep. That one's more than likely on, one of the first things to be impacted, I would say, when tax rates do increase. But yeah, so there's RSUs for you as far as kind of really basic view on those. And
strategically, I was just going to kind of throw out too, strategically there, Jeremy, are we seeing most of our clients right now, knowing that they get taxed on them immediately when they vest? Or are we seeing most people just go ahead and sell them right away? Or are we seeing a lot of people hang on to them?
I think what we see most often is it's kind of a mix. Depends on the company. Honestly, what we see with our clients, I think Josh and I have been in their ears long enough that if our clients know that they have a large position in that company, as soon as those units vest and become unrestricted, they are on a schedule to kind of get rid of them as they come along. The key is these RSUs can actually put you, they can directly affect your tax situation in two ways. Obviously, the capital gains if you hang on to them, but also depending on how many shares you're getting and what the value of them is, those get counted as ordinary income. Ordinary income can change, that gets added onto whatever your actual salary is, right? So if you have enough of these, they can actually push you into a different tax bracket. So there's definitely some tax planning opportunities with these, whether it makes sense to sell them as soon as they vest, to take risk off the table. A lot of different factors involved, but I think we've seen a little bit of both, Josh. We've seen people who are very disciplined and say, I don't want to keep too much of my money in this one company. And then there's others that say, this is what's funding my retirement, or I know this company's good. I like our direction. I'm going to hang on to them for a while. Yeah.
And we can't hit home enough that really there's risk with having one company. In other words, if that makes up an outsized part of your portfolio, which, if it's more than 5 to 10% of your overall portfolio, I would start to get concerned. In other words, if you're looking for kind of a rule, in other words, that's my rule is maybe no more than 5 to 10. And then the fact that you start to look at things like, well, my health insurance is there, my 401k, my paycheck, all that stuff. People do start to think about that. Again, it can be really tempting to hang on forever if your company has done really well. And in a lot of cases, we have had clients that their stocks just keep going up and up and up. So we just want to hit home on that. There's an opportunity with RSUs versus some of the other types of benefits end up having some longer vesting schedules and advantages to hanging on longer. With RSUs, that third point in there that you can immediately sell the shares at market price with no further tax due. In other words, it's not going to have any more tax consequence for you to sell right now, especially if you're finding that you have a lot of RSUs, maybe a lot of them are unvested. And then maybe you've done stock purchase plan, maybe you've even got some options on top of that. You can end up with a lot of company exposure, and I'm seeing a lot of people sell. I'm seeing a lot of people just use the opportunity. It's just kind of automatic. Each time they just sell when they vest.
Mm-hmm. Yep. And there's two more points on this one. Kelly has a question here saying, what happens to the stock value once they vest, basically once they become unrestricted, and ultimately that's at the market happens. Whatever happens in the market happens to the stock. It can go up, it can go down. Obviously, most people, we buy stocks in hopes that they're going to go up, but we have seen it go both ways. Absolutely. Very good question.
Yeah. And it could be kind of, it may have been along this line too, that the reality is because some of the shares, if your employer does sell some of your shares to cover the taxes, then that's true. I mean, if you end up receiving them, they end up vesting, it would be worth a little bit less because some of those shares aren't yours anymore. They went to the IRS and maybe your state.
Yep. The other thing too, not a lot of people think about, and not every company does this, but we ran into a situation earlier this year where a client reached age of retirement according to that company's plan and had all of these restricted units that were out there waiting to vest. And then as soon as he hit age of retirement, company says, according to our plan, all of these shares are going to vest right now this year. So instead of having to wait for years 2, 3, and 4, all of his shares vested. And so you can imagine a little bit of a surprise to him, definitely a first world problem. Now I have all of these RSUs that vested. I have to pay, the ordinary income tax on that. His company is the kind that took it among themselves to actually withhold some of the shares and pay the taxes, so he wasn't surprised by a big tax bill. But also another thing to keep an eye on, whatever the plan says, if it says age 62 is what it is, or age 59 and a half, whatever that may be, once you hit that retirement age, we're going to vest everything. That's something that could definitely take some planning. So it says the sooner you know that, the better, the more you can plan for it.
Yeah, for sure. So you definitely want to understand your plan. And so it's very individual. We've seen clients both ways. Sometimes companies have benefits that's tied into your retirement if you're retirement eligible. In some cases, all your RSUs you get to keep. In other words, you kind of stay on the same schedule and everything, even after you're not an employee. That can be great. But in other companies, when you walk out the door, any unvested options are gone. So it's important to understand those because you could end up being really disappointed, of course, if you thought that money was yours and now it's not. That could be really unsettling.
Yeah, absolutely. So let's go on to the next one, Josh. Non-qualified stock options. So these are probably, next to RSUs, some of the most used by companies. They're pretty straightforward. There's not a whole lot of tax advantage to exercising the options and hanging on to them, other than if you think, it's going to go up. But again, if we think of company exposure and what that all entails, usually a good idea to, once you get them, sell them. We don't have to worry about capital gain stuff. 100% of the ordinary income when you do exercise these, and it basically just gets reported on your W-2. Okay. So if we go to this again, we're going to go back to those 3 dates basically, which also have prices attached to them. the grant date / price, the exercise date, and the sale date. Now, when we're talking about stock options, those first two, you get the date that it's granted at, and there's usually some kind of discount that is attached to those options. So it says, we'll allow you to buy this many shares at this price. Okay. And then you hang on to that. And then once that option is allowed to be exercised, you exercise it. So it's basically saying, hey, I'm going to take this option and I'm going to turn it into actual shares. That the price difference between what the fair market value is on exercise date and what the discount was on that grant price, that is called the bargain element. And so as soon as you exercise that option in whatever year that happens, that bargain element piece becomes taxable at ordinary income. Okay, so that's FICA, FUTA, all those fun 4-letter acronyms that nobody remembers until you're looking at your W-2 come tax time. And you say, why are all these people getting a piece of my paycheck? All right, so that's the bargain element is really what we're talking about here for taxes. Again, once it's exercised, it becomes an actual share. You have the ability to sell it at any time. With non-qualified stock options, you don't get any other benefit other than potential gains that the stock might do, holding on to it longer by hanging on to it. Again, if you do choose to hang on to a non-qualified stock option, NQSO, NSOs, you're subject to capital gains rates, same as before. If you hold it for 366 days or more, it becomes long-term capital gains. If you sell it within that first year, it's taxed at short-term capital gains. And that's just whatever gains it has after that exercise price. Okay, so again, not a ton of it, unlike some, we'll get into incentive stock options here in a minute where it gets a little more complicated than that, but really this is about as simple as a stock option can cut.
Yeah, they're pretty simple. And what we find people doing, because there really is no advantage to hanging on, we do find almost everybody that has NQSOs or non-qualified stock options, almost everybody just exercises and sells immediately. In other words, that's how you put the order in, is that it just exercises, it sells immediately. So the other thing to keep in mind on stock options is that there typically is an expiration date. So be aware of your plan, be aware of how that actually is going to work. But unfortunately, with stock options, because they almost always have expiration dates, you could end up kind of up against the wall versus back before when we were talking about the RSUs. Those you could just kind of hold on to the stock forever, assuming it doesn't become an Enron or something like that and goes to zero. Let's say that something happens and the stock drops by 20%. You could just hang on, wait it out, hopefully sell at a higher price down the road. With non-qualified stock options, if they have an expiration date, we saw this happen at a lot of tech companies back in the 2000s, is that people had a whole slew, sometimes thousands or tens of thousands of stock option grants that ended up expiring worthless simply because they received those options in the late 90s, early 2000s at a very high price. The exercise price was so high that the stock price never went back up. It never went up to the point where they were able to exercise and get a profit. So just keep in mind that there's kind of that extra risk here with stock options. It's a stock option. It means that you have the option to buy the stock at a certain price. And of course, you would never buy the stock if it's above current market value. So that's what ended up happening, is they just expired worthless. A lot of really disappointed people, of course, because that was supposed to be a significant benefit for them. That's what a lot of people were kind of counting on for a portion of their compensation.
Yep, absolutely. Good distinction too. It is the option. Okay, so incentive stock options. Tell you the truth, these are a lot more rare nowadays, but we do still see them. And so with an incentive stock option, the thing that sets it apart is that with there's two key dates which would allow you to change that bargain element from ordinary income into the more the better looking long-term capital gain. Okay. And so there are actually some tax advantages to exercising it and then holding it. Now, the key to incentive stock options is there's 2 dates. So you need to hold these 2 years from grant date and 1 year from exercise. And then this also attaches to alternative minimum tax. And so with these, let's go to the next slide and we'll put some visuals on it because these can get kind of complicated pretty quick. But the key here is, so you see that bargain element section. So grant price, or let's say grant date and exercise date. The first time frame that we have to meet in order to qualify for the best tax option on this is you cannot exercise the option until 1 year after grant price. Okay. So all of a sudden we meet that first one. That's great. The second time frame says, all right, we can't also sell until 2 years after that grant price. All right. So if we break it down even further and say, okay, 1 year between grant price and exercise price, and then 1 year between exercise price and sales price. And if we meet those two time frames, then you're eligible for the longer term benefit. Now, the other part of this too is that bargain element. Now we're talking across 2 different tax years as well. So how do we account for this over 2 different tax years? The bargain element, or the difference between the exercise price and the grant price in that first year, gets counted as alternative minimum tax. And so basically, if you think about it, it's almost like an NSO at that point. Whatever that is gets counted as ordinary income, basically, and you pay the taxes on it up front. Okay, now that comes back to you on the back end, and we'll show you how that works here in a minute. But up until then, this is, it's very much very similar to non-qualified at this point in that first year. Okay. Anything to add to that, Josh, before we get into the
just alternative minimum tax? If you're wondering what the heck is that, that's probably because you've never been subject to it before. And that's a good problem. Congress has actually, over the years, they've kind of made it apply to less and less people. And really what it was meant to do in the first place is that there were some people that were just paying no taxes back in the day. And so they said, all right, we're going to have this alternative minimum tax to make sure that everybody pays something. So unfortunately, when they did it, is they didn't really raise the limits. And so more and more people ended up becoming subject to the alternative minimum tax. And a lot of people were paying it at tax time, not very happy. Again, Congress over the years has raised the limits high enough that not many people are impacted, but this is one that we still see. This is one area that people sometimes will be subject to AMT if you've got incentive stock options. And really where we're seeing these, if you've got incentive stock options, more than likely you're pretty high up in the company. You're pretty high up in a publicly traded company, probably the C-suite or some other executive position, or it could be that it was kind of a founder's grant. In some cases, we're seeing that when a company is a startup, they will do ISOs, especially for some of those earlier employees. That could be something that they're dangling as a carrot for people to really work hard and get the company to go.
Absolutely. So just like we said, there's these 2 dates, right? These 2 timelines that we're talking about. In order to qualify, you have to meet both of them. Just one of them doesn't work. So if you were to exercise the stock option before 1 year from grant price, all of a sudden the ISO doesn't matter anymore. It basically becomes a non-qualified stock option at that point, and you're subject to those terms. Or if you meet the exercise date 1 year, first timeline, but then you sell it before that next year is up, same thing. That's actually probably one of the worst things, is because you're paying, your ordinary income on that bargain element, but then you're also going to pay short-term taxes on the capital gains. So you're really putting yourself in a hard spot there. But overall, it's the key to an ISO is you have to meet both timeframes. As long as you meet both timeframes, you're good to go on the taxes. All right. So I think the next slide is, we put some numbers behind this. And so might look a little confusing here, but let's keep it simple. So on January 1, 2020, we were granted 1,000 shares options, I should say 1,000 options at $5 per share. All right. The options are granted. They're not exercisable yet. Non-taxable event. Okay. Nothing actually happened. You don't actually own anything as of yet. You just have the option to buy. Okay. 366 days later, on January 2nd, 2021, the share price is at $10. So if we look at that first section, that bargain element that consists of the exercise price less the grant price, we are going to have about $5 per share. And so $5 per share times 1,000 shares, that's $5,000. That is the subject to alternative minimum tax. Okay, so basically gets treated like ordinary income at that point. So on your 2021 taxes, then you would have that 5,000 subject to AMT on there. Okay, so then we're going to jump forward another year. Now we've met the first one, the first timeline. Let's say we meet the second timeline, and so it's been 2 years past that grant date and 1 year past that exercise date. And now all of a sudden these shares are at $15 per share. All right. So what happens here is now the IRS sees these timelines and it says, okay, you've met your timelines. This is what we're going to do. They say that original $5,000 that you had to pay as alternative minimum tax, we're going to give you a credit. Basically, they call it an AMT adjustment on your taxes. So you paid it, but they're saying, well, we're gonna give you a credit on the 2022 year for that amount. But then we're gonna go back and we're gonna figure, okay, what is the actual long-term capital gain then on the entire transaction? And so we have to look, well, roughly we're at $15,000 now. And it was at $5 when it was granted. So the difference, the 1,000 shares times the $10 difference between grant and fair market value now, that's $10,000 of long-term capital gains. And so that's really what they're looking at there. So if we think about it, $10,000, let's say you're in the 24% tax bracket, you're going to probably be paying about 15% flat capital gains tax. That equals out to, about $1,500 or so, but then you already paid the $1,200, on the basically $1,200 is $5,000 from the bargain element. So that would be the tax due AMT. So that gets credited back. In 2022, you end up paying $300 tax on the entire transaction. So when we put the two things together, overall, that entire 1,000 shares from grant until sale costs you $1,500, but actually gave you the benefit of about $10,000. Okay. So like we said, these can get a little bit complicated, a little bit quick, but if we try to break them down into their individual years and look at them in sections like this, it tends to help out a little bit better. Okay. Anything to add to that one, Josh?
Yeah, as you can tell here, there's a lot of complexity. It's just really important to understand the rules of your plan, understand exactly what you've got. Again, these are stock options. So just remember that you don't have to exercise anything. In fact, because they will have an expiration date at some point, they're just going to go away if you don't do anything. But of course, then you're leaving a lot of money on the table potentially. So it's just important to understand what the rules of the game are. If you've got incentive stock options, just recognize that you could do exactly what you did with the non-qualified stock options. When they become available, you just sell them right away, you pay ordinary income tax. Maybe that's the right decision for you. And that's fine if you decide to do that. But for people who say, I'm willing to take the risk, in between of the stock going down, I'm willing to kind of hang on for a while. In other words, buy the stock and hang on to it for a while. There could be some tax advantages for sure.
Mm-hmm. Absolutely. So that's kind of the best case scenario on incentive stock options. All right. If we go to the next slide, now what happens if we don't meet both of those timeframes? All right. So all of the assumptions are the same under this. Same time frame, granted 1,000 shares at $5 a share on January 1, 2020. Again, non-taxable event. Well, what happens if I exercise those before 1 year from that grant date? Well, just like that, automatically those basically become non-qualified options again. The bargain element piece between exercise price and grant price becomes ordinary income. And then you can choose to hang on to the stock options or not. In this example, we're saying, hey, we're going to hang on to them and continue on. So the 1,000 shares have been exercised at $5 a share. Instead of the AMT adjustment, it's just considered ordinary income. And so that's $5,000, or in the 24% tax bracket, that would be a $1,200 tax bill on those 1,000 shares. Okay. And then let's say, okay, so now we're going to say we're going to hang on to it for a year. We don't like paying short-term capital gains, even though we had to pay ordinary income tax on it. So we're going to hang on for that year. Then the remainder, the difference between the fair market value at sale price versus exercise price. Well, if you remember back, we had exercised at $10 a share, and now it's worth 15. So that makes another $5,000 of long-term capital gains. Long-term capital gains at that 15% tax bracket on $5,000, that's going to be an additional $750. So by meeting our timelines in the previous example, you paid a total of $1,500 tax on these shares. Now, because we missed one timeline, we're going to pay $1,950 on that. All right. And this is just very simple. This is just 1,000 shares, and we're talking about $5 increases. Okay. Now you can imagine if you were to jump it up by $10 or $20 per share or whatever, that might work. Or if you also missed the long-term capital gains rate and you sold it before the 1 year time frame was up after exercise, now you're going from that 15% tax rate. If you're in the 24% tax bracket, you're going to go to 24% that you're paying on these. And so instead of paying $1,500, you might be paying as much as $2,400 on this grant specifically. So it definitely pays attention on ISOs to pay attention to grant dates, grant prices. Again, there's a lot of moving parts on these, but if you miss just one, you put yourself at risk of paying more taxes than you really need to when it comes down to it.
Yeah, and I think that's a good point too, is that it's important to understand the rules of the game. This is another example here of somebody who left money on the table. You never want to do that just because they didn't understand the rules, they didn't anticipate. And it could have been that they would have benefited from working with the tax advisor. That's something that we should tell you all. I think it's in our disclosures at the bottom. But when you get into income tax stuff, you do want to consult with your tax advisor, with your financial planner. Make sure that you're not just doing this on your own, because that's really where people kind of hit those biggest mistakes, is when they just aren't aware of something and they ended up making a mistake when they could have really averted, in some cases, a disaster. The worst scenario I ever ran across, this is I shouldn't say my favorite story because it was really sad, but somebody had stock options. And remember, I told you before, these are stock options. These do not have to be exercised. That means that you have to proactively say, yes, I would like to buy the stock. Well, I ran across one early in my career. This is before a lot of the fancy trading and everything that people could do all this stuff online. Back then, they actually were doing it manually, where you had to fill out a form and they had you fax it in. Well, I had one person that they exercised some options that were underwater. And what I mean by that is that meant that the market price of the stock was actually below the exercise price. Exercise means that you're buying. You don't want to buy for more than whatever it's trading on the open market. So those were underwater options. So they actually ended up paying more in the exercise than what they could have done if they just went out and bought the stock on their own. So just keep that in mind. That's a kind of a crazy example. I was only saw that one time. I'm sure trading systems now would keep people from doing that. They would warn you and all that. Well, back then it was just a fax in and they had to accept the order. So that person ended up making a big mistake, and big mistakes can be costly.
Yeah, absolutely. And so then kind of the final one that we'll talk about today is stock purchase plans. So these are pretty common, I feel. company puts the stock available out there. Typically, in order to make it worth your while, they'll put some kind of discount on it. I think in past years, decades ago, the discount might have been a little bit nicer, but nowadays we've seen anything from like 5 to 10 to 15%. I think a 5% discount is, pretty likely nowadays. Unlike, 401k contributions on these, it's after tax dollars. So you're usually it is a deduction from a paycheck. And so you can elect to be part of the stock purchase program. And they'll say, okay, how much do you want to do? And you pick a percent of your salary, almost like contributing to a 401k. But instead of getting the pre-tax benefits of a traditional 401k, you just say use after tax dollars. And as part of every paycheck, you basically get a couple shares. Okay. Now, these are the nice thing about these is that they are taxed at sale of the stock. And so there's still a bargain element, basically the fair market value from when you purchase it minus the discount price, but it doesn't get taxed on you until actual sale of these. Okay. Again, the big thing with these is going to be capital gains. So you purchase it. It's almost like purchasing it in the open market. The only big benefit is that you get a discount. So instead of buying it and having to wait for it to go up, you buy these shares and they're automatically worth more than you actually paid for them. Okay. Again, as long as you hold it for 366 days or longer, you get that long-term capital gains. Okay. Same kind of ideas here that we're talking about. You still got that bargain element part. You still got that capital gains part, and you get the time frames that are attached to it. And so for this example, we went really simple with just dollars, but you can see there is, some benefit to it. Again, disqualifying events. So we still have to be subject to those qualifications of time frames. So 2 years of grant, 1 year from purchase. Again, as long as you're still meeting those time frames, you're not leaving any more. You're not leaving any money on the table, as Josh likes to say, right? So the coolest thing about these, though, again, is that unless there's a disqualifying event, nothing really happens until sale as far as a tax standpoint.
Great. So, and those are pretty common. A lot of companies offer stock purchase plans. Again, disqualifying event, it doesn't mean you're doing anything wrong. You're not doing anything illegal. In fact, you might decide that's what you want to do is sell right away or as soon as you can. Simply, you might just say, you know what, I got the 15% discount on the stock. If that's what your company offers, that's a good deal. I got to buy, I'm going to sell right away. I don't care if the taxes are higher. I just want the cash. And so I can take it and do something else with it. So that's completely up to you whether you hang on to it or not. Just recognize there are some advantages to holding, and you'll have to weigh those with yourself, your tax advisor, your financial planner. Mm-hmm. So with that, this stuff is pretty complex. And as we come to the end of the hour here, you might be completely confused by now. Hopefully we did our best to, try to simplify it as much as possible. But bottom line is this stuff can be pretty complex. And especially because it is so complex, it's very, very open to receiving, some big mistakes. In other words, there are some opportunities that could be lost because you just don't understand the rules. Tony Robbins said the complexity is the enemy of execution. And that's the temptation with stuff like this, is that it's just information overload. And I'm just not going to do anything. I'm just not going to think about it right now. And that's why the average American is kind of walking around right now and not completely happy with their financial situation, simply because the financial world just looks too complex. And employee benefits like this can be very complex. And it could be something you just don't understand what to do. It could just mean you don't do anything. So Richard Branson, I said, complexity is your enemy. Any fool can make something complicated. It is hard to make something simple. So our job really at Keystone Financial Services is making the complex simple. And you can see on the page that we've put in here, the grid page here kind of shows you the major areas of financial planning. When we talk about being comprehensive financial planners, and that's what we are, is CFPs, certified financial planners, we're comprehensive financial planners, meaning that we actually look at everything in your financial situation. Now, that doesn't mean that you won't have other advisors like a tax advisor or an estate attorney, but really the role of a CFP is to kind of look at the entire picture, look at where you are now, look at where you want to be, and then coming up with a game plan that will help you move forward. We've touched on a lot of these areas today, and certainly equity awards end up covering a lot of these boxes. It certainly ties in. And the value of financial planning is that we're not making all these decisions independent of each other. We're really looking at how they all interact with each other and really what's going to be the best for you. And again, as a fiduciary, that's our role, is to be helping you figure out what's the best for you. And not what's the best for us or anybody else, what's the best for you and your family. So definitely take us up on that. We want to have a conversation with you. And really our team, we've got a team that really cares about our clients. And it's not just because we like money. We think money is interesting. We think the financial world is interesting, but really, we really care about our clients. We want to know you and your situation and how we can best be helpful. So with that, we'll accumulate some questions in the queue here. If anybody has any questions, go ahead and type them in. While we're doing that, I just wanted to say thank you for those of you who have to drop off, or maybe you're at the end of the video if you're watching on YouTube. Thank you for attending today. And let's make sure that we stay in touch if anything in here resonated with you or makes you want to dig into it further.
Absolutely. And I'll second that. Yeah, use that question and answer feature if you're still online here. Otherwise, yeah, please use us as a resource. These things are, they like Josh said at the beginning of this, stock options, equity grants of any kind can be game changers for your financial situation. They really can. It's important to treat them correctly and to pay attention to the details of them so that you get the most benefit out of it. And so that's not something that anybody should have to feel like they need to fly solo on. If anything, use this as a resource. We're absolutely happy to do this. And also, as a parting thought, we did have one last question. Yes, this recording will be available. Typically, we like to put this up on our YouTube channel, and you can typically find them through our website as well. So yes, if you missed any part of this or had to leave early or joined late, you will be able to see the full recording on our YouTube channel via our website.
Yeah, keystonefinancial.com is our website. For those of you who don't know us as well, keystonefinancial.com is our website, and there's social media links right at the top. So just watch for that over the next 24 hours, and please share it. Use the opportunity to share this. And for those of you who are watching after the fact, of course, please share this with anybody that you think would find this valuable, as well as please give us feedback. If there's feedback that you've got for us, or maybe topics that you'd like us to talk about or educate you on, financial education is one of our core values. So we do want to make sure that we're covering the things that are important to you. So with that, anything else, Jeremy? Any other questions we've got to answer at the end here?
That is it. No further questions.
Great. Well, thank you everybody for attending. Thanks so much for, really interacting with us and giving up your time today, and we'll catch you next time. Thank you.
Take care.